Welcome back, you legends. I'm Dr. Cal, and this is the last chance to get out of the market unscathed. Smack that like button right in the face on your way in, and let's get this done. Let's take a look at the S&P 500 and the various indices, all in the green today. Look at how crazy this last 10-minute closing market candle looks like. Absolutely nuts. Goes to show the type of exuberance and FOMO, fear of missing out, that is in the market right now. The market is in a dangerous place. I'm going to get into that very quickly in this market update video. Here is the hourly chart for the NASDAQ 100. The NASDAQ has been leading the market out of this market bottom that formed early August after the Japanese stock market blow up. Since then, we've been on an absolute tear, a vicious short squeeze that is now coming to an end within potentially as early as tomorrow. Let's take a look at why that is very likely the case. Again, this is the hourly chart for the NASDAQ 100. At the bottom here is the RSI. Very rarely does the NASDAQ 100 put in a top before establishing a bearish divergence. First, what is a bearish divergence? It's when the stock or ETF continues to hammer in slightly higher highs as the RSI begins to form lower and lower highs. It happened here. It put in the top, got a pullback. Again, happened here. Equal highs, significantly lower high on the RSI. Put in a top and then pulled back again. Same exact look here. Melt up higher, put in the final top, bearish divergence on the RSI, put in a lower high, mark the top, got a significant sell-off. Now we are on track to put in that top potentially as early as tomorrow. We've hit some key levels on the chart that I'll discuss, that I put out in my market notes today in the Discord community. Here's what I put in just before the market opened at 9:27 a.m. Eastern time. This is the hourly chart for the NASDAQ 100. I pointed out these bearish divergence structures. I said in an uptrend, rarely does the triple Qs top before establishing a bearish divergence. First, this has been true pretty much in every single case in an uptrend going back multiple months. This bearish divergence typically lasts between 2 to 4 days. As of the close of today, Monday, today is the third day in this bearish divergence. Tomorrow will be the fourth. Typically, the fourth day gives us the top. Usually, everybody, when the market begins to form these bearish divergences, it is time to take profit. That's why we've been focused on taking profit and looking at that defensive rotation for when that pullback comes in. We make money on the way down and then make money again on the way up. That's how we like to play it here. We like to make money on the way down and on the way up. By the way, I'll post the link in the comments below if you want to join the trading community to get access to these real-time market analysis notes. I followed up with another note intra-day in the market. It talked about the NASDAQ 100 being potentially just $3 away from topping. We have this very key 480 target, gap fill target, that I was anticipating to get filled as early as tomorrow. Before the market opened, I was actually looking for a gap up to fill the gap, then come back down. We filled the gap at the last 10 minutes in the trading session. Take a look at this. This is the 10-minute chart. Just look at how crazy looking this candle is. Massive volume, a huge move up. I was looking for this kind of move to happen overnight, get that gap fill complete, and then bring us down. Typically, when the market rips to the upside at the end of the day in the last 10 closing minutes, that typically means that the market would gap up higher the next day. And so for tomorrow, look for something that looks like this. A gap up continues to rip in the first hour, 2 hours, and then get that reversal and then begin to head back down, and giving us that top that we're looking for. We're looking for a top anywhere in this vicinity, right? Previous resistance, gap fill complete. So look for something that looks like this, right? Anywhere in here in the mid 480s, and then that reversal on the second hourly candle. That'll be the telltale sign to get out. That'll be the last chance to get out as the market either pulls back and then continues to sell down, or pull back and then begin a consolidation phase. What about the S&P 500? The S&P 500 has that exact same look. In fact, I want to direct your attention to this market move. Gap up higher, a bit of a pullback, then continues to rip higher, finally putting in this double top and then pulling back to the medium term moving average, this purple moving average. We have pretty much the same looking structure here. Gap up, moved higher, then pulled back and continued to rip. We're now looking for that double top as early as tomorrow for that final chance to get the heck out of the market before it begins that next cycle to the downside. Again, if we take a look at the NASDAQ 100, almost identical looking move. Look at this. Market opens higher, gaps up, then rallies, pulls back, rallies and rips, and then puts in this double top. Look at this. High here, equal high or slightly higher high, establishes the bearish divergence, and that's it. We get that sell-off. Exact same look here. Gap up, move higher, pull back, then get that final rip. We're now looking for that double top and bearish divergence, setting us up for that sell-off to come. Let's keep things going here. The VIX up top, S&P 500 down below. The VIX is now beginning to establish this range. Look at this, opened higher today. The VIX opened higher, then gave back that gap, and it is now beginning to establish another key divergence. Look at this. This is the VIX beginning to move lower in what looks like this falling wedge, bullish falling wedge, as the RSI is moving higher. This is a classic bottoming formation for the VIX. The VIX loves to form bottoms just like this one. First, we get the gap up and then we move all the way back down. The next key signal, the second key signal to watch now, is for the market to actually move up and then for the VIX to move up in tandem. That would be the last warning to get the heck out of the market. Typically, when the VIX begins to move up higher, as the market also moves up higher, typically that's the last warning sign to get out of the market. What it actually means is that even though the market is moving up, big money is beginning to rotate out of call positions and into puts, anticipating a sell-off in the market and a huge rip in the VIX. That's what I'm looking for tomorrow. I'm looking for the market to head up higher and then for the VIX to actually also move higher. Usually these two are inversely correlated. When the market is moving up, you want to see the VIX moving down. When they're moving together, that is a hidden signal to get out of the market. One major key chart that I discussed in my last couple of videos. I talked about this chart a lot. It's the XLY divided by XLP. That is consumer discretionary relative to consumer staples. That's up top. Below here is the S&P 500. I'm looking for this ratio chart to rally back up to this level to fill the gap at 2.33. Once that happens, I expect a rotation out of consumer discretionaries, out of risk on sectors, bullish sectors, and into defensive sectors as the market begins that pullback and consolidation phase that could last upwards of a week. Tomorrow, Wednesday, we'll have a bunch of Fed speakers, Bostic and Barr, and then Wednesday, the big report to watch is the FOMC minutes. Expect a huge market move in reaction to the FOMC minutes, either the day before, the day of, or the day after. That is very common to see a volatility spike just before the FOMC minutes. And if that happens, if we get a sell-off just before the FOMC minutes, then expect a rally on the minutes. If we continue to rip higher just before the FOMC minutes, then expect that volatility spike to come in after the FOMC minutes come in. So it's a contrarian indicator. Whatever the market does before the event, in this case, the FOMC minute release, typically the market afterwards will do exactly the opposite. So if we rally ahead of the event, everybody's euphoric, very optimistic, then the data disappoints, the minutes disappoint, and we get the sell-off. The opposite is also true. Everybody very pessimistic heading into the FOMC minutes, then they get released. They're not as bad as feared, and we get that reversal. It's basic market psychology where everybody is expecting something. The market often likes to do the opposite of that exact thing. That's why as early as tomorrow, very likely is the last chance to get out of the market. Lock in your profits and sit this sell-off out. Sit this next period of weakness, consolidation, sell-off, whatever it is, sit it out. Again, look at this pattern, gap up higher, move and rip to the upside, and then just stall and then get the sell-off. Almost the exact same looking structure here. Fear and greed continues to rise. We're crawling our way out of extreme fear into neutral territory. That is rarely a smooth sailing event. Usually we get a bump. Usually we get a bump that is coming. Usually we get a bump. Sometimes it's a small bump, right? Just a small bump. Sometimes it's a bigger bump. Smash the like button right in the face. This is all I have for you today, legends. Thank you so much for watching. If you watched till the end and you did not enjoy the video, I thank you for your time and attention. That's it, folks. I'll catch you in the next one. Bye-bye.
Oh, wow.